Well, hi there. Welcome to Markets Tomorrow right here on ET Now. A disappointing close for the session and a disappointing close for the series in the way we came off from talking 8,000 to knocking at 78.50. That was a big U-turn for the market intraday and no attempted pullback that saved the day for us or brought about a graceful level. The index tumbled 500 points on the Nifty, on the Sensex nearly, and on the Nifty as well, 130 points lower is how that index closed trade. That's the market, this series, and the returns flashing on your screens. But suffice to say that what started off with a bang in this week, and the expectation was that we perhaps might expire at 8,000. That didn't quite play out on expected lines. So on balance, the index closed up about 1.5% for the April series, 1.5% for the Sensex. The broader indices did more by way of returns. So the mid-cap index was up nearly 4% for the April series, and the small-cap index rose about 4.5–5% odd for the last 30 days. We'll discuss what the close today, means for the start of the May series and whether or not the market can make a comeback from here, given the internals. Voices lined up on the show that we will be discussing market outlook with Adrian Movat of JP Morgan, who spoke about policy action globally and its impact on emerging markets. Mahesh Nandurkar, India strategist at CLSA, will talk about his investment thesis for India. And Mayuresh Joshi, fund manager Angel Broking, will highlight his investment picks at this point, given that every falling market would turn out to be an opportunity to buy companies and stocks at a cheaper level. And Kunal Bothra will help our viewers with trading ideas to approach trade tomorrow. To the top stories, and there were plenty in the markets today. The Nifty saw profit taking on expiry day, with the index ending a good 130 points lower with no attempted pullback in sight at the time of close. Almost testing 78.50, closing just shy of that mark after talking 8,000 at the start of the show and the start of the session. It was a complete U-turn for the market by the time we shut shop. There was a lot of policy development which also influenced trade. The Fed decided to keep rates unchanged, and also the expectation of a possible second rate hike in June has been revised a bit lower. In fact, the chances of a rate hike then have diminished to less than 20% after the policy statement that was issued yesterday. So that just, continues to be a bit of an uncertainty for the market on when the Fed would decide to hike rates next. The Bank of Japan also surprised as it kept on hold its stimulus. There was an expectation that they would expand the QE program, the stimulus program in the region by 10 trillion yen, so from 80 trillion to 90 trillion, but that didn't happen. There seems to be still some concern about economic activity not picking up, inflation not picking up in Japan. However, the BOJ wants to be, safe than sorry, so, does not want to infuse more than the required liquidity in the economy. And the yen, more importantly, took a stark reaction to that decision. Rather than weakening, it staged a strong rebound and strengthened further, almost knocking at 109 to the dollar. In terms of our market, drilling it down to specific names, it was really Yes Bank, which rallied 4% on strong Q4 earnings. You had Bharti also react to positive Q4 earnings. HDFC Bank hit a fresh lifetime high in the session. And this is amidst all the volatility and negative trade that panned out. Jubilant FoodWorks dipped about 11% after a big block deal. And of course, realty stocks rallied. So a whole host of Bombay-based real estate companies were active, as the BMC may look at hiking the FSI in the region. The question that we are asking is, will this trade of sell in May and go away actually play out as we step into the new series? Mayuresh and Kunal, good evening to both of you. Kunal, start off with you. How confident are you of the May series, given the fact that after that big sell-off in February, you had March, which pretty much captured the rebound rally for the market, and then you had April, where some bit of the headroom that was left over was also kind of conquered. Where do we go from here? Because we pretty much covered lost ground for the first 2 months of the year.
Yeah, good evening, Tanvi. I believe that the first half of May would be, more difficult, because, it would be difficult for the markets to probably gather a trend. I believe that in the last 4 months, for Indian markets at least, it's more or less been, not just the domestic factors, but I think it's more of a global play, which has impacted, the trend for Nifty. The first 2 months for 2016, when the global markets were tanking, and, similar thing happens for India as well. And over the last couple of months, you've seen some decent rally happening in the global markets. Now, I think the trend for our markets, or how do I look forward, would be the way the global markets pan out. Because if you sense, or if you see any sense of a major correction happening in the Asian indices, I think that could probably trigger some sort of a more severe correction, to say so, for our markets as well. So I believe what we saw today, for the Asian markets, and so far for the European markets as well, is probably an indication that it's going to be tough, next couple of weeks. But I think once the storm gets settled, and if there is not too much of a damage, then I believe that the Indian markets can actually rise once again. So in terms of levels, the first important support which I am looking at is 7,700 on Nifty spot. And I think till the time we don't take out that support, we could probably be in a safer territory, to say so. On the other hand, I think 8250, which I've been mentioning, that's the most significant resistance for Nifty on a medium-term basis.
Okay, thanks for that perspective, Kunal. Mayuresh, I'll talk about the broader markets in a bit, but first let's drill it down to earnings. And to my mind, on the index, there hasn't been any major disappointment. I've been reiterating this for the last two sessions. And correct me if I'm wrong there, on the top line and on the margin front, companies have mostly delivered. There could have been some adjusted changes that could have impacted the bottom line performance. But, revenue growth is a clear indication of demand revival, and that seems to have actually turned out to be positive. Out of the numbers that came out today, Dabur, ACC, HCL Tech, what stood out to your mind?
Evening, Tanveer. See, out of the numbers that have come so far, yes, it has been an encouraging trend. But the larger picture remains on how the rest of the pack is going to perform, how PSU banks are going to perform, what is going to happen to the construction stroke infrastructure segment. And yes, I think the few numbers have exceeded expectations in terms of how the top line has panned out, how the margins have panned out, and to a certain extent a trickle-down effect on the bottom line. Now, out of all the companies that have probably posted numbers, I think ACC has given a decent show in terms of what volume growth they had posted, much better than what a lot of analysts on the street had probably penciled in. And again, it's a long drawn out story, so I think if the government push comes through, as one really expects, towards the housing and infrastructure sector, the utilization levels for a lot of these cement companies will start inching upwards. If that starts happening, you already seen realization in terms of cement prices, specifically in the northern and western parts of the country, start inching up. So that has stability in terms of pricing. A whole host of companies have moved towards petcoke consumption, so the input costs remain extremely benign, specifically in their power and fuel subhead. So I think cement as a theme is something that I like. ACC, in my opinion, has given a good set of numbers. HCL Tech did disappoint in terms of what the guidance probably came through, because a lot of analysts were expecting decent revenue growth in dollar terms to come through. That probably did not emanate. But again, I think the EBIT performance was quite reasonable. It was more or less in line with what I was expecting. And again, I think the management is pointing over towards very robust CY16. So again, HCL Tech is something that we'll continue to prefer within the large cap IT space.
Okay. Were you surprised by Dabur's volume growth?
Not really. And again, if you look at the kind of competitive intensity pressures that it's not just Dabur, a lot of these FMCG companies are facing at this point of time, it is going to take some amount of toll in terms of how the volume growth pans out. But again, I think if you look at the core portfolio and the subheads within which the business functions, our own take is that Dabur is an extremely strong franchise. Yes, I think the competitive intensity pressures might have a toll from a short to medium term perspective, but I'm pretty sure I think the management has a strategy in place. And again, I think if the monsoons are better than one really expects, I think the industry size itself is very, very large. So to that extent, I think the volume rebound can happen across categories that Dabur functions out of. that input cost deflation that we probably witnessed for a lot of FMCG companies, that is probably into the price in terms of how earnings have panned out for the better part of FY15, 16. But again, if one probably takes future projections, it's going to be more to play on how the volume growth happens and how realizations pan out, which in our opinion, if monsoons turn better and rural demand comes back, we'll have a huge fillip onto stocks like Dabur. So again, I think it's not a short story, but if somebody has a long view of more than 2 years, I think Dabur is an interesting play within the FMCG pack as well.
Okay. Kunal, on the charts, we've just discussed HCL Tech and Dabur. Dabur recovered from the day's lows. HCL Tech was a key loser. What's the trend looking like?
Yeah, I think for HCL Tech, Tanveer, I think the trend seems to be, weakening, once again. I think there were some signs that when overall the IT pack recovered, I think Infosys, TCS, when we've seen some sharp recovery, even Tech Mahindra for that extent. But I think HCL Tech is probably continuing to maintain its downtrend. I think on the longer term charts as well, it's now inching back to break its previous low, which is closer to 790 approximately. So my sense is that the stock can probably drift down far more further. If it breaks the 790 mark on a weekly basis.
Also, Yes Bank in this session, Kunal. On the charts, do you see the trend continuing, moving from one point of strength to another?
Absolutely, Tanveer. I think this is one stock. Even Yes Bank and IndusInd Bank, I think both have moved from strength to strength over the last 5 or 7 weeks. And I think this is a good sign because when the entire sector was struggling, lack of private sector names which are showing some good signs of trend, and these couple of stocks, Yes and IndusInd, I think they've shown some very strong momentum. And at a time when the index is at a critical point, 8,000 psychological mark, it's struggling to break that, and have these. They are strong uptrend trading at lifetime highs. I think is a very good sign. So even if these stocks probably undergo a correction, say 5 or 10%, if the index also goes into a correction, I believe that it's going to be a very good stock to probably invest into.
All right, Kunal. That's a 30% move coming in on Yes Bank, 945. Good going for this counter from the lows in December and then in Feb. It's a good comeback. We'll take a break. When we return, we will essentially be focusing on how to approach trade tomorrow. It may be the last trading session for the week, but the first trading session for the new series. As we take that break, here are Mahesh Tandurkar of CLSA highlight his India strategy.
The Nifty is now trading at 16 times, more than 16 times 1 year forward earnings. Whereas the last 10-year average has been about 14.5, so we're good about 10-12 percentage point premium. The forward earnings estimates of 16 plus is based on an expectation of earnings growth of 23% for FY17, which I think is still very optimistic. More realistic number will be closer to 15%. As far as the market valuations go, there isn't really much room for re-rating.
Welcome back. Still watching markets tomorrow right here on ED Now. Earnings to watch out for tomorrow. First up, ICICI Bank. And Poonam joins in with a quick snapshot of what to expect from the private sector lender. Poonam.
Well, yet another quarter of high NPA stress is likely by ICICI Bank. As a result of that, the profits are just about to grow at just about 7% at 3120 crore. But the net interest income is still likely to be growing at around 9.5%, and the operating profit growth is likely to be pretty much strong at around 30-odd%. We should be seeing marginal dip in the margins on account of interest rate reversals, and the analysts are working with a number of 9 to 14 bips a sequential dip in terms of the margins. Other income as well as the operating income is likely to be high on account of gain of stake sale in the insurance subsidiaries to the extent of about 2,000 crore should the gains be in terms of the stake sale in the insurance subsidiaries. Not just that, of course, asset quality remains a key monitorable. Management did guide that the fourth quarter NPA stress is likely to be similar to what we had seen in the third quarter. In terms of the third quarter, we did see the GNPAs jumping up nearly 33%. Management had also mentioned that the slippages are likely to come in from the restructured assets book, so watch out for that. And also high amount of slippages are still pending from the power sector as well as from the steel sector. And as per the RBI AQR, they have only recognized 60% of the stress so far in the third quarter. Also watch out for management commentary in terms of how they will be utilizing the proceeds from the stake sale in the insurance subsidiaries, and any commentary in terms of the listing of the insurance businesses, and also of course the overall growth outlook in terms of the loan growth as well as their expectations in terms of margins and CASA. Any further negative commentary in terms of the asset quality stress, if it will be similar to Axis Bank, it is of course likely to be to put some more pressure in terms of the stock price.
Thanks, Poonam, for that. Up next, Marico as well comes out with numbers. Mubina, what can one expect?
Well, a decent set of results is expected from Marico, especially when you look at it. The base was quite low, at least in terms of volume growth. Net sales are seen bumping up at 7% at 1,310 crore rupees. EBITDA as well is seen growing by a good 23% at 210 crore rupees. And on account of that, margins are seen expanding by a good 200 basis points. And lastly, bottom line as well, because of the growth in EBITDA, is seen growing at 22.7% at 135 crore rupees. Now, overall, analysts are expecting the domestic volume growth to come in at 10%, bucking the overall trend that we have seen in fast-moving consumer goods. Parachute is something that is going to come in with volumes at 7%, but it's Saffola and the value-added hair oils that are going to put in a good growth of 10% each. Now, it's something, remember that Parachute had taken a price cut of around 5 to 6% in January 2016. So, because of that price mix-led deflation, there could be some pressure on the top line, or rather that will cap the kind of volume growth we have seen on the top line. And lastly, a big, positive for Marico has been the fact that copra prices have dropped a good 39 to 40%, on a year-on-year basis. So that's something that's boosting margins, and the EBITDA growth is leading to the bottom line growth that we are expecting to see of 23%.
Thanks, Mubina, for that. Come to you, Mayuresh. How would you look at Marico as well as ICICI Bank's earnings tomorrow?
Tanveer, so largely ICICI Bank will factor in a weak set of numbers going into results tomorrow. Slippage is expected at elevated levels as seen in Q3. So you can expect slippages to the tune of 2,200, 2,400 odd crores. What they had provided for 2,800 odd crores last time would be an interesting aspect to watch out for. And the restructured pipeline of 11,200 odd crores, what slippages probably emanate out of that, and the management commentary related to that would be a key monitorable. Yes, I think you will see some amount of compressions in NIMs for this quarter to come, but what happens with loan growth, what happens with the deposit growth are also interesting aspects. So I think asset quality more or less on similar lines. You're probably even looking at the 525 and the SDR book. As it panned out, I think the management had given an indication that there would be certain accounts that will still get needed to be recognized under 525 and SDR. So the quantum thereof will be an extremely key monitorable as well. As Rubina was pointed out for Marico, my own take is that volume growth should be around the 10% odd mark. With the fall in copra prices that we've seen, the input cost deflation is going to be very, very evident on EBITDA margins. And my own take is EBITDA margins should be in excess of 16 odd %. When it comes to the value hair added segment, oil segment, apart from Parachute, it is again going to be an interesting segment because Parachute, as Rubina was mentioning, has taken price cuts, and that will have some amount of impact on realizations. So I think an extremely good show is expected from Marico on all counts, top line, EBITDA and bottom line.
Okay, the year-to-date chart on both these stocks just flashed for our viewers, and it's been a steady run on Marico, almost 11% return year-to-date, and for ICICI Bank, it's gone through its dramas for the year. It's a bit of a comeback, but not quite in the green as yet. However, the last couple of weeks, you've seen some good days for ICICI Bank. Kunal, where does the trend go from here?
Well, I think it seems to be like ICICI, even though it's rallied, I think around 25-27%, in the last 2 months from those lows of 180, 183, 185 approximately. But there still seems to be a lack of conviction, because even over the last couple of days, you've seen some selling pressure emerging. When the stock headed towards that 250 mark. So there seems to be profit booking, some amount of circumspection, which you can see on charts at least. So I believe that there could be times where the stock can probably go into a correction. I believe that over the next couple of days you may probably see 225 to 30 kind of range for ICICI Bank. I think that is where the stock would probably stabilize.
Fair enough. Kunal, your strategies for viewers to approach trade tomorrow?
Yes, Tanvir, I'm going with one long and one short. The first one is a sell on Reliance Infra. I think the stock just about broke its swing breakout today. It's also broken the 20-day moving average, which is a good indicator for the stock over the last couple of quarters. And I believe that with that sign, you could probably see some sort of correction happening in Reliance Infra in the first half tomorrow. I would look at closer to 520 as a target, intraday target, keeping a stop loss of 545. And the second one is a buy on Indigo. I think the stock is inching towards a swing breakout. Also on today's market, it was one of the few stocks which managed to close almost at the high point of the day. So I'm sensing that you could probably see some follow through in terms of momentum. I would look at 1098 as a target on Indigo for tomorrow, and a stop loss at 1045.
We have just about 30 seconds to close the show. One top idea from you, Mayuresh?
What I really like, Tanvir, in this market is a stock called Engineers India. And one really needs to buy this stock on declines in a very staggered manner. The order book is expected, in my opinion, to grow at 13-14%. With OMCs pursuing capex, and the intention is very clear at this point of time, expecting 13 to 15,000 crores worth of orders to flow through the next year and a half, 2 years. And that will emanate into their order book as well. And with better order book coming through at better execution and better margins, the cash flows can improve drastically. It's a cash-rich company, and the dividend yield also is quite reasonable. So in my opinion, I think the top line growth and the bottom line growth should be quite reasonable for Engineers India. Staggered way of buying this stock over the next 2 to 3 months. I think good returns can be expected over the next 1.5 to 2 years.
Great, gentlemen. Thanks very much for taking out the time to speak with us today. Appreciate your views as always. That's a wrap on Markets Tomorrow. We leave our viewers with another important voice, this time global.